Here's how to play China safely in the stock market. Everyone's talking about China right now as they're reopening from COVID. And this is a big market you want to play because it's got one of the biggest demographics in the world, over 1 billion people. They have a big economy. They're the largest, if not the second or third largest economy in the world, depending on which metric you want to use. So you want to be invested in China at all times. If you were invested in 2022, it was an abysmal year. You wanted to stay as far away from China as possible. Most people in general have a disdain or fear of Chinese stocks. So there's a way to play China, but you have to do it safely because China doesn't play by the rules. So here's the way to guarantee at least mitigated risk or conservative income from China. And I say income, not daily gains, okay, cap gains. We're going to do it through income, okay? Here's how we're going to do it, okay? First of all, we're not going to buy stocks. We're not going to buy the ETFs outright. We're going to sell options on those funds. That's how you mitigate your risk safely with China. Okay, I've already had other videos discussing examples on how when you sell put options on things, it actually makes your cost basis much more attractive and your entry point is lower than the current market price. Okay, we'll get into a whole video on just selling options in themselves, but for right now, we're talking about how to play China. And if you are somewhat of a savvy investor and you want to play China, but without the risk, you should look into selling options once again. Okay, for example, I'm doing yen, which is the triple FXI long on China. And instead of buying yen outright, which is a fund, an ETF, not a stock, it's a collection of stocks. Instead of buying it outright, I'm selling options on them, selling put options. I don't really know what the prices are. I don't care. I'm about to show you right now. Okay, I'm going to show you. I'm going to take over my computer. I'll show you the premiums I received. We'll look at the strike price, and we'll look at the strike price minus the premium, and then that's the new adjusted cost basis. And you'll see that's the much more favorable way to play China. Okay, so first thing you're going to do is not buy the stocks outright. You're going to buy the ETFs. The second thing is you're not really going to buy the ETFs. You're going to sell options on those ETFs. Okay, and I'm going to show you what I do over here in the portfolio in a second. The third thing you're going to do is hedge with a short on China so that you get a net credit in the process. So you might spend $500 to $1,000 on the short, but if you're netting $2,000 to $3,000 on the premiums from selling the options, then you're still at a net credit of about $2,000. So let's go check that out. Okay, I'm going to walk you over here. Okay, also going to show you what the portfolio did for the day so you can see the potential that we have here. I always like to show this on the channel. So these are the day's gains from today, almost 6,000, 5,700. Okay, the S&P had a nice move up today, but it's up against the 200-day moving average. I've been telling you guys this is bearish. I am a bull on 2023, but short term prices look like they're going to be going lower because every time they hit that yellow line fail, yellow line 200 fail, yellow line 200 fail. Okay, all right. But I'm going to show you the options that I sold on yen, and this is the triple of FXI, I believe. Doesn't really matter what the vehicle is. This is yen, okay, and the strike price at 50. I received on yen. Says here where my mouse is there, $17 each, almost $18. So $1,800 because these are in options contracts. You multiply times 100, and I did 2 of them. So I have, you just multiply that times 2. So 18 times 2 roughly $3,600. Okay, but then I have the put option here. I mean the triple short here. Yang. See where my mouse is? Yang. Okay, so I'm down in it about $300. I have 572 in Yang. Okay, I'm down in it about $300, but look at the put that I'm up in. And the put here in yen, I'm up $900. And that's just in the open market. I told you, overall, I'm guarantee these premiums if I just let it expire. But I could take the profit right now. 900 minus 300 is a net $600 profit. But I don't want to take a profit because I want to keep the exposure of China on. After all, my goal is to make as much money as I can, but I don't like to invest outright in things because they can burn you. Our approach, as you know here, is they're an estimated, you can see through my estimated income. Our approach here is dividends. This is a passive income channel. We only care about dividends, okay, and monthly dividends at that. They come in the mail, okay, about 8 to 10,000 a month, okay. So again, days gains are nice. The market's at the 200, expect a pullback, but I want to find a way to still play China in the process, okay? My big aim is passive income. As you know, that's what this channel is for. But, you know, you get FOMO, you know, you don't want to miss out. You don't want to miss out on the Kathy Woods ARK funds or China taking off. I mean, look at the prices here at China, okay? If you let me just log into this, you'll see that we're at all-time lows still in China. We've had a big run. But look at this fall, okay? Look at this recovery China has had. Okay, it's moving, okay? It's moving up from 20 to 30. So that's almost a 50% move China's had. But it's still, look at it on a max chart. It's still way off its high. It's high. So 60 is the high, you know, so, you know, and the range of the lows are in the 30s. So we're at this lower end of the range. We've made it past the 200. That is bullish, but short term you can see a pullback, but because we're at the 200, it's had a big move off the lows. But long term, these are still cheap prices, as you can see on a 10-year chart. So I've sold the put here. You know, no matter what it does, I'm guaranteed my premiums. And if it goes lower, if we instead go lower, well, on yen, okay, I have the puts here at 64. I had the strike price at 50, if you remember. So 64 minus 50, I have $14, so it even hits my strike price. But y'all know that I receive $18 per contract. So you do 50 minus 18 to find your true cost basis. So 50 minus 18, that's about 32. So 32 is my true cost basis. That's where I'm at a break even, okay? The stock has to fall from 60 something to 30 something for me to just break even, okay? And that would happen, my shorts would start cleaning up on the other end. So this is just a risk-free way almost to play China, okay? I have all these other puts that I've sold so I can get this extra correlation and performance in my portfolio, but the main aim I've told you are dividends and monthly income. And we're passive income investors here, but we just don't want the FOMO of missing out on China. That could have multi-year runs on you that you don't want to miss out on China. So if you like the video, click subscribe, click like, and stay tuned for further videos. I hope you enjoyed. Have a good night.